As usual, take note of long-term context, which is a large downtrend in this case. Then incorporate short to medium-term observations such as the neutral range over the past few weeks. Bearish price action is still present with regular downswings, but for nearly 8 weeks, large bullish volume spikes and strong closes lower have been less common as neutral to bullish price action keeps the market relatively unchanged. Now the lower boundary of the range, near 8.00, is a key support, especially with the current large drop that only has normal levels of volume. The flat bottom range has been breached with adequate volume to start October, but this is a brief occurrence as neutral to bullish price action returns, and selling volume is almost absent. This points to the possibility of a muted bearish continuation and the formation of a large bullish reversal if the upper 9.00 boundary of the recent flat bottom range can be surpassed soon. Now the lows centering around 740 form the basis of a progressing double bottom on a large scale, with the upper boundary closer to the highs of the last downswing in late October around the 9.00 to 920 range. The double bottom is nearly complete but now faces substantial headwinds as clearance over 920 has been hampered by the past 3 days of heavily bearish sentiment. Now it is crucial to watch short-term developments. As usual, volatility creates uncertainty and reduces the effectiveness of the pattern, as a bullish break is put into doubt. Technically, the double bottom completes successfully, but the late January volatility has reduced what was otherwise a stable uptrend, taking off from early December. Similar to other examples, a pattern has completed with less spectacular results, but the overall long-term market sentiment has shifted. In this case, the bullish intent of the double bottom is carried on as later downswings and upswings make successively higher lows prior to the aggressive incline that would have likely come earlier if the double bottom wasn't delayed and hampered its stable path to completion. After a solid bullish run over the prior highs, the 18 to 1775 range now becomes a crucial support as the market shifts into a neutral to bullish phase. Bullish activity has steadily declined since the new highs were reached. The firm foundation of support combined with the return of moderate bullish spikes revives the case for a more likely bullish continuation. As usual, there is lower activity in late December due to the holiday period, from Christmas to New Year's. This phenomenon doesn't always result in a bullish carry over to the next year, but rather a period of rest and indecision until normal activity resumes in the new year. The new year starts bullish, similar to other chart examples, though it should be noted this and other chart examples with bullish New Year's starts often had broader bullish context from December or earlier. It is possible for a chart to also take a neutral or bearish path to begin the new year, especially if the broader context is conducive. Naturally, 18 to 1775 now presents a key long-term support range. In this case, short-term volatile and bearish price action progresses rapidly. While there weren't full downswings in late December, there was a clear incline and plenty of bullish volume spikes. In fact, this forms an ascending triangle outline that even has a bullish New Year spike complete the pattern. This uptrend line now becomes a helpful reference for the larger uptrend. It is a great example where a compact pattern still retains the general price action of a larger pattern outline, but results in a significant long-term breakout. Interestingly, December started with a full upswing that was preceded by moderately bearish volume. This began the gradual shift from short-term bearish sentiment to increasingly bullish sentiment in the short, medium, and long term that an ascending triangle theoretically represents. Just like before, it is important to wait for conclusive developments even though short-term developments present bearish and volatile price action and red volume spikes. The long-term uptrend line is not relevant until there is a large drop. Speaking of uptrend lines, there isn't one in July, but there is a slight incline while relatively low activity continues. A bullish continuation gradually completes, with bearish volume slowly declining towards August. The 2765 level marks the role reversal from an ascending triangle's resistance range, offering crucial support with the bearish retracement stabilizing the uptrend into August. The uptrend line intersects near the closing price of the July 8, 2015 candle, because that was a clear bull hammer forming a compact upswing. The penetration over the lower wick was normal, given that day also had above normal volume. Like normal, the uptrend lines from the ascending triangles reduce in influence, but still summarize the overall uptrend that continues into 2018, with a large failed head and shoulders. Further long-term bullish sentiment is also seen with the minor detail around June 2017. That is a failed double top reversal. As usual, a failed head and shoulders often presents a gradual but noticeable incline with the right shoulder. This example also shows how bearish volume can still be high on the right side, but as long as the proposed neckline range is not breached, the pattern is less likely to complete successfully with a large drop. As the chart establishes new high ranges, a clear double top reversal becomes increasingly probable. Now, all that is left to wait for is a conclusive break under the lower boundary, centered around 6240. A large red candle and red volume spike are exactly what was expected, with the double top that had perfect bearish features in terms of volume and price action. It even has a slight decline from the high of the first downswing to the high of the second downswing. Interestingly, the double top has a gap down fill level of 6430, shared with the high of the failed head and shoulders. The lower boundary marked by 6240 lines up with the secondary feature around the head, when there was mostly flatter price action between June and August. An uptrend line from the failed head and shoulders also identifies the approximate area of a minor uptrend in 2018. The descending trend line and the 5920 area presented stronger resistance potential but were still passed due to an overwhelmingly strong uptrend that was still slowed down for a brief time. Most of the uptrend's strength was concentrated around late July at the site of a bullish break to complete a triple bottom. Interestingly, the old downtrend line also intersected with 5920 to mark the stronger temporary support potential of a compact and volatile right shoulder, in a head and shoulders with fairly symmetrical proportions. It is also worth noting the steeper downtrend line intersected with the gap down fill area for extra strong resistance moving into December. Technically, there was a head and shoulders outline into 2018. Centering around the double top for the head. and there is a wider head and shoulders outline over the past 2 years. However, these observations are more realistically seen in hindsight. They would not have practically been identified and utilized by most market participants during their development. The giant head and shoulders was also less precise. At the end of 2018, when the neckline was breached with volatile trading, it would have been more practical to note the importance of the 50 boundary reversing rolls to offer critical long-term support and the stable descending trend line, rather than just using the pattern's lowered precision into 2019. The large drop is halted by the mid-20s range, which is derived from the previous ascending triangle. Speaking of ascending triangles, there was another one in more of a range-bound context to make a firm return back into the 40s. Naturally, its upper boundary concentrated around the 42 level, which is a crucial support in the event a bearish reversal prevents clearance into the 50s.